Greeting mortgage professionals. This is Wolfie on Wall Street and your Mortgage Minute. Brought to you by a man who's worked in the correspondent and wholesale lending for nearly 40 years and has prepared for you all of his insight and knowledge on how this affects the mortgage industry. Today, how does the government shutdown affect mortgages and the housing market? And what does this do to your day-to-day? And what departments keep you from doing your job? Along with a new update on how safe your borrower's information is when they attempt to open up a new loan application. While the government shutdown may cause temporary disruption to some borrowers, it is unlikely to have a major or lasting impact on overall mortgage rates. In fact, mortgage uncertainty often causes rates to dip slightly as investors move forward towards more secure assets like treasury bonds. Immediate effects of a government shutdown is minimal, and the impact on most rates, potential mortgage rates, are primarily influenced, of course, by the bond market. The past shutdown show that it is not significantly impacted by the temporary government closure. Possible delays for government-backed loans. The most significant effect is the potential for delays in processing and closing loans backed by federal agencies, such as those from the Federal Housing Administration, FHA, or the Department of Veterans, VA, or essentially their services will continue with reduced staff, which could cause slowdowns. Equally reduced capacity for reviews, some types of loans, like those requiring manual underwrites or extra staff reviews, may experience longer wait times. FHA condo approval process may also be paused. More recently, the flood insurance disruption and the National Flood Insurance Program, NFIP, will not issue or renew any policies for homes in flood-prone areas during the shutdown. This can halt estate closings and those areas until the funding is restored. Thus, if you have a closing currently, where the Fed policy is about to expire, flood policy rather, your existing loan may not be able to fund until the shutdown is over and a new policy may be installed. The longer-term effects in market vitality is market uncertainty. The shutdown can cause a multi-diversity and delays in the release of crucial federal income data, such as inflation and job reports. Federal Reserve decisions without up-to-date with the Federal Reserve March perceived more cautiously with interest rate decisions, which could impact lowering costs. Although there may be a typical drop in rates, as nervous investors may move to take their money into more secure treasury bonds, causing bond yields and mortgage rates to fall slightly, as has happened in previous shutdowns. A potential for correction if the shutdown is prolonged. The lack of data could create disconnect between market expectations and reality. With reporting resumes and sharp connections, corrections could follow. On a positive note, a new law has been passed that the days of clients being bombarded with calls and texts from random lenders when you apply for a mortgage loan is ending at last. Starting March 2026, your personal information stays private. Only your chosen lender or your current servicer can in fact reach out to you. That means that no more chaos when you apply for a loan. You see the big corporate mortgage companies who clearly state that all of your brokers are submitting loans to lenders that do not do retail. It's of course a lie. They pay big money to the credit reporting agencies, title companies, and the like to give them notice when your clients are taking out a mortgage application. So why continue to send them business? UWN Rocket Mortgage just engages in taking your clients and you're still sending them business. But why? Because they have the best rate? Well, here's the question. Is it the best rate if they just bought your client and you will never see them again? As a former Countrywide employee, I can tell you that this is nothing new. Even when they get a payoff demand and you think you're in the clear and you've got your clients back, they will make them an offer that they cannot refuse. So why do business with gangsters? Would you take your children to school knowing that they were going to brainwash them to become soldiers for someone else's cause? No, of course not. So why would you give your business away to a company that doesn't care about you? They're only interested in your clients, and their only concern is to take your business away. But let's get back to the good news. Mortgage rates are predicted to fall during this government shutdown, as we've seen non-QM lenders lowered their rates today by as much as 1.25% in rebate pricing. Past government shutdowns have resulted in lower rates as investors seek for safety of the bonds, with falling rates everywhere else from 1/8 to 1/4%. Where 30-year currently priced at 6.375 could easily drop to 6.25 or even 6.125 in the coming days. However, there still could be a random effect that's installed on loan processing. Government-backed mortgages face delays. Most significant interruption would be the processing of government-backed loans, including, of course, FHA, USDA, and VA. While the VA is expected to continue guaranteeing loans, reduced staffing at federal agencies and the Department of Housing and the Housing and Urban Development HUD could significantly slow down applications and approvals. USDA loan has a freeze as the Department of Agriculture, and the USDA is expected to halt all issuance of new direct and guaranteed home loans during the entire shutdown. Further delays could be engulfed by the IRS and NFIP, as loan processing of all type of mortgages could be affected by delays from other agencies. For example, the IRS, already understaffed, it may not be able to process income and tax transcripts, and your requests could sit empty, often required for a loan approval or funding. Additionally, lapse in the National Flood Insurance Program will, of course, delay any closing in a flood-prone zone, unless, of course, its policy is clearly extended throughout the funding requirements of your said lender. But here is the big question on everyone's mind. Will the Fed cut rates again, now with more government layoffs? In light of recent economic developments, the Federal Reserve will likely cut interest rates again. Joy. While this is complicated and, of course, convoluted by the ongoing government shutdown, the prospect of more government layoffs adds further weight to the Fed's concern over a softening labor market. Key factors, of course, is a weakening labor market ahead of the government shutdown, which began October 1st, 2025. Economic data, with the persistent signs of cooling job markets, will continue in the private sector. Job growth in September missed expectations, and revisions revealed that the economy added far fewer jobs earlier in the year than initially reported, which of course increases the Fed's focus on employment. The Fed's dual mandate includes a chilling maximum employment, which of course cuts risk management, mostly to prevent future labor market weakenings, which is highlighting the Fed's increased sensitivity to employment risks. However, there are widespread expectations of further cuts. Market analysis widely expected more cuts already, even before the government shutdown, which many predicting that there may be a potential of 2 additional cuts of 25 basis points by the end of 2025. Some lenders, including non-QM, have already priced in nearly a 90% chance of a December cut. So the pressure for the government layoffs, as the proposed massive layoffs, I suppose, are in fact carried out, this would exacerbate labor market weaknesses and significantly damage the economy, which would increase pressure on the Fed to cut mortgage rates to support employment and economic growth. Although many might be saying that this is the possibility of the influence for uncertainty for the government shutdown, as government layoffs strengthen the case for federal cuts. The shutdown introduces significantly for the uncertainty of the Fed, which is tasked with a data-driven decision. This, of course, raising conflictions, experts' opinions saying the shutdown has divided the opinion of the immediate next step. Some suggest the lack of data will cause the Fed to pause, while others argue that the pre-existing evidence of a weak labor market is enough for the Fed to cut rates and proceed with another cut in December. The presented outcomes is that October's cut is cemented. If the government shutdown is prolonged, it includes mass federal layoffs, which could reinforce the Fed's concern about the labor concern and potentially lead to the late October meeting, despite the lack of official data. If the October cut is delayed, it most likely will result that shutdown ends quickly. The Fed may wait for increasing release of new economic data. So confound the assessment for taking action, a longer shutdown does in fact increase the risk for the Fed with 2 cuts to avoid acting without critical information. However, as multiple cuts are still projected, financial institutions like JP Morgan, Chase, and Fidelity says that this remains the likely projection, though the precise time depends upon the resolution of the shutdown and future economic data. As such, my recommendation to you, my good fellows and ladies, is to, in the coming days, block those loans quickly. Take your borrowers to the finish line. If you are not being guarded by the slowdown of the IRS, transcripts, and flood risk markets, or any government agency. Lastly, keep your eye on rates in non-QM. Major lenders have decided to become more aggressive despite the lack of data. That is Wolfie's Mortgage Minute. Thank you for joining me today. God bless you, and work tirelessly with conviction and truth in your heart to do the right thing for your clients. Be furious in your work if the market favors you. And good night. Thank you, ladies and gentlemen, for tuning in to Wolfie on Wall Street and the Mortgage Minute. Please remember to subscribe, to like, and to comment. And if you have any questions, please put them in below and we'll see if we can possibly use them in our next segment. Look forward to seeing you soon. And now it's martini time. Next week we bring you a howler. Oh, night.